everyone. Welcome to the next session of the Founder University series. This is our last session on the capital raising series. So we're very excited to have two speakers for this session. Leith Martin, who we've introduced previously, and you all may know from a number of our previous sessions, is going to discuss due diligence and deal rooms. Leith is on our team. He's the executive director of the Troche Center for Entrepreneurship, and he leads deal flow and is one of our GPs here at StartUpNV. And then we will hear from JD Peters, who will go into cap tables. And I'll briefly introduce JD right around the half-hour mark after after Leith is finished up. But with that, Leith, thank you so much. Please take it away. I'm gonna turn your mics on now, and you should be good to go.
Thanks, Logan. Logan normally reads this really. You were here last time, long bio, and it's incredibly uncomfortable. And so I'll do a brief intro. My name is Leith Martin. I'm the executive director for the Troche Center for Entrepreneurship Innovation at UNLV. I'm also a GP in 1864, the seed fund, and help manage deal flow at StartUpNV. So I've got a lot of material to cover, specifically around due diligence, because we've got to make sure JD comes on. He's an attorney, so we have to be prompt with JD at 12:30. So if for whatever reason I don't get to all the stuff on the deal room, I'll make sure that Audrey has all of my deck information. She'll send it to everyone, and then you'll be good to go there. But let me talk a little bit about due diligence. And the way I'm going to cover due diligence is I'm actually going to talk about it. A lot of the discussion is going to be around the perspective of the investor, because I think it gives the founder a little more insight as to what the investor is looking for when they're doing due diligence. And this is actually a deck that I use sometimes specifically for the Angel NV group around due diligence as well. So the due diligence itself is the investigation or analysis the investor performs to ensure an investment opportunity meets their criteria for funding. The primary objective is to mitigate investment risk by understanding the company and its business. Now, why is due diligence incredibly important? The reason it's so important is let's say that you were going to rank each one of these things, right? So the management is capable, the market demand is as expected, which we all know is incredibly risky, right? We don't necessarily know what the market demand is going to be. But let's say we ranked each one of these a 9 out of 10, which is pretty dang good, right? So all these criteria were ranked 9 out of 10 on all these different categories. The likelihood of success is 48%, right? So the best deals, because of likelihood and probability, is 48%, right? So if I rank each one of these a 9 out of 10, so in other words, a 10 out of 10 is just no-brainer, absolutely there, 100%. The team is the best they could ever be, whatever. But I give each one of these criteria 9 out of 10, then the probability of failure or success is 48%. Sorry, stay here.
Anytime.
Yeah, sorry.
Away from the mic, stay here.
Sorry, no problem. Just multiply 0.999 times that many times, right? So 0.9 times that many times equals 0.48. Yeah.
You're at 48%.
So that's why due diligence is incredibly important, because the reality is the likelihood of success in general is incredibly low, even under the best sort of deals. So you have to uncover everything possible in terms of what's going to happen. And if even one of these drops from 90% success to 50% success, meaning you're worried about one of those things, then the total probability of the deal falls to 27% as opposed to 48%. That's why due diligence is important. Now, when, as an investor, should you engage in due diligence? And when, as a startup, should you expect an investor to engage in due diligence? The first thing is when you've met their criteria, right? So lots of investors invest based on certain criteria. We only invest in certain industries. We only invest in deals that are pre-revenue or post-revenue. We only invest in deals that are compelling. We only invest in deals that will exit in 5 years or less. Whatever the criteria are, you should never enter due diligence unless you've made all the criteria. Now, from the founder standpoint, you should never pitch to someone that you know you don't reach all their criteria. Because the vast majority of the time you're going to get an immediate no, because guess what? You're pre-revenue and they only do post-revenue deals. So don't waste your time when you're actually looking at potential investors and trying to get investors to jump on board on a deal that you don't actually meet their investor criteria. The invalid reasons why investors sometimes engage in due diligence with startup is it's what's left, right? It's the last potential date at the bar at the end of the evening, right? Those are terrible reasons. Sometimes it's because they have extra money they need to invest, or I have a certain number of deals I want to do in a year. Those are terrible reasons for investors to do deals, and sometimes they do them, right? So investors often say, I've got $1 million this year, I want to do 10 deals. And then towards the end of the year, like I'm 2 weeks out, I've still got 200K, I got to find 2 deals. Well, that's a terrible reason for people to invest, but it happens. All right. Yeah, that's right. From the investor standpoint, for the founder standpoint, you'll take it, right? So how is due diligence often done? And this is important in understanding for founders because often it helps you navigate what you should be looking for and how you should expect the due diligence to take place. So oftentimes due diligence is done and led by a single person or a single organization. And sometimes that's called the lead investor. But oftentimes I've seen angel deals done where there's a particular angel who everyone knows in the network is going to serve on the board, and they're going to show up for all the meetings, and they're going to send out all the updates, and they're going to spend a great deal of time due diligence. So lots of other investors will often invest in a deal if that lead investor is in. So it's important when you're trying to figure out what investors you want to invite and what kind of a due diligence they want to. It's important in identifying who that lead is. Because they're ultimately going to be probably, the sheep are going to follow the lead. And so you need to make sure you understand who that is. Oftentimes they will share the due diligence package with other people, especially if you're dealing with something like the angel syndication network. Oftentimes one lead group will do the due diligence package, and then they will share that due diligence package with everyone else in the syndicate who asks for it and wants access to that. Sometimes there's a due diligence committee. For angel groups, sometimes there's a committee that looks at every deal. And then they do the due diligence, and then they share it with the other people that's in the group. Sometimes outside law firms are hired. It is a two-way due diligence process. You should be doing due diligence on the investor. Now, what I mean by that is when you're desperate for money, as oftentimes founders we are, sometimes if somebody's just willing to consider investing, then we take them on. Like, oh yeah, that's great, we should take them. But the reality is that some investors aren't good for your business, and they're not good for you. So just make sure that you know something about them as well. Sometimes professional firms or consultants are hired to do due diligence. Sometimes investors do it themselves. Most investors will not sign an NDA, especially not early. Maybe if you're giving them access to some proprietary information that you have in your deal room or something like that, but the vast majority of investors are not going to sign NDAs. And if I'm being honest, if you ask someone to sign an NDA for you to pitch them your opportunity, then it shows a bit of naivety because the vast majority of investors are going to think, they've never done this before because they've asked us to sign an NDA. All right. Investors shoulder the cost of doing due diligence for your firm, for your organization. You should not be paying for the due diligence that an investor potentially wants to have done on your company. If they're not willing to burden to take upon themselves the cost of due diligence, more than likely they're not sincere about it as an investment opportunity in general. All right, other things that they will do due diligence on, and you should expect them to do due diligence on the team, right? Oftentimes that means they may check your credentials. If you say that you graduated from MIT with a master's degree in electrical engineering, they might check that. So don't put it on there if it's not true. I have seen at times where investors will do a background check on someone just to make sure there's not anything major in their background check that might be a bit unusual. Oftentimes they're not looking for maybe some financial things. Now, if you've committed fraud financially, obviously that would be a problem, but they're not necessarily looking to see if your credit score is 550 or 850. More than likely what they're looking for, are there any legal issues in your past? Right? Oftentimes they'll also be checking on things like your mindset. What's your leadership ability? Do they feel comfortable that you can lead the organization to some level of exit? Do they think that you have integrity? Are you honest? And they might ask other people those questions about you to try to figure out what they know about you. They want to know if you're smart enough to pull it off. Doesn't mean they're going to give you an IQ test, but they're going to basically, from conversations, they're going to be weighing your intelligence. And finally, they're going to try to figure out if you have good judgment. Investors, so in terms of reasons that companies fail or successful, one of the primary reasons is the quality of the team. And so it shouldn't be surprising, that team or checking on the team is one of the major things that investors are going to do when they're checking on your your startup or you individually. All right, so what else do you expect in terms of due diligence? They're going to judge your value proposition. How significant is the value they're providing to a potential customer? Is it real? Is it significant enough that it will change the behavior of the customer so that they will use your service versus a competing service? Is it a mosquito bite, meaning it's a bit irritating, so I'm probably not going to make any major changes in my behavior? Or is it a shark bite potential situation? I'm not getting in the water because it's so severe that there's no way that I'm actually going to do it. So I'm going to change my behavior to use your product. And usually the higher the value proposition or more significant the value proposition, or the more significant the pain the customer feels, the more likely they are going to change their behavior. So they are to change their behavior. What does your distribution channel look like? On a lot of deals that I've looked at, this is one of the things that worries me the most. And the irony is because I think it's oversimplified sometimes, and there are lots of things that go into distribution that startups don't necessarily consider. What's your differentiation from other startups or other competitors? What's your general growth strategy? Do they think that you can pull it off? Do you have recurring revenue? Lots of investors obviously like to do deals that have recurring revenue. You don't have to kill your next deal for your next meal. You can basically have a continuous pipeline of cash that comes in and helps to support the business. What's the total capital requirement for the company? That's going to be something they're going to want to know. And the reason they're going to want to know, that's the reason that when you do a deck, it has the ask and it has the use of funds. It's because they want to know how you're going to spend the money and see if they agree with that in the way that you're going to spend the money. The other thing they're going to look at, obviously, is the deal structure, right? So what is the valuation of the business? What's the deal in terms of, is it a safe? Is it a convertible note? All of those kind of things. And then finally, what's the exit strategy? What I find interesting about the deal structure is I would have told you that 5 years ago, maybe the number of deals that I would see that had a safe was maybe 10, 15%, pretty low number. I would say over 50% of the deals have a safe as opposed to convertible note. So sometimes the expectations change. Lots of early stage investors did not like safes, right? Because it was basically just a contract. Even though it didn't really provide that much more protection than a convertible note, at least the convertible note felt like a little more of an instrument that had more bite in terms of access to IP and stuff like that. But to be fair, it didn't really provide that in a literal sense, because if a company went out of business, none of the investors ever went in and said, I can't wait to take the IP and try to build the business, right? So there wasn't traditionally any value there, but it felt like there was more. And then finally, what is your exit strategy? The interesting thing about exit strategy to me is that every investor in the room, when you're giving a pitch and you're talking about your exit strategy, knows that you have no idea what your exit strategy is. They don't even believe the one that you provide to them. But the truth is, if you don't talk about it, investors are incredibly uncomfortable because they think, wow, is this a lifestyle business, or is this a business they actually plan to sell and allow us to get our money out of it? So they all want to see an exit strategy, but they know you can't predict the future in 7 years. So there's a pretty good chance you don't really know it, but you try to provide it in order to provide some level of comfort. It makes everyone more comfortable because they're like, oh yeah, they're actually going to try to get out of this business one day and provide us some sort of exit.
We do have some questions from online. You want us to save that for the end?
You can interrupt. Yeah.
All right. So the questions from online, probably know we address this first one. What does IP is defendable mean?
Yeah, so good question. So I will tell you that if you ask JD, well, actually JD is a corporate guy, so probably not JD. He's the attorney coming up next to talk about. He's doing the next session. But if you ask an IP attorney, they're going to tell you this, that you should patent everything, you should protect everything to the hilt. Why? Because the truth is they're incentivized to say that because they make money off basically people filing and protecting their IP. When I say IP that's defendable, what I mean is that you should never get any or pay for or apply for any intellectual property patents and others that, one, you can't defend, and two, that don't provide value to your business. The reality is that there are lots of people that have IP, and sometimes it does provide value to the business because investors may say, oh, I'd like the deal more because there is IP. And they may or may not investigate whether or not there actually is value in the IP and whether or not you can defend. Because what I mean by defend is that the USPTO does not police use of intellectual property. They basically just issue intellectual property in terms of allow you some level of protection in saying that you have this patent. The reality is for you to make sure someone's not using your IP, you have to sue them. Sometimes you can send them a letter and with a cease and desist, but sometimes they don't care. And so if you can't afford to defend the IP, sometimes it might be better to keep it as a corporate secret or to keep it another way. Because the truth is that most patents take about $1 million to defend, and that's if a relatively small organization. If you're suing Apple, good luck, right? I mean, good luck. So understanding that defendable IP is incredibly important. Was there another question?
Yes, it's a couple. If a founder cannot guarantee an exit in 5 years, should they not pursue the investment? For example, they want to keep running their business, the open goal is IPO. So, there's no way to guarantee that, but it could happen within 5 years.
Yeah, it's a good question. It depends on what level the investment is. Most angel investors have a pretty good idea that you're not going to exit in 5 years. So they know it's going to be probably more like 7, in some cases 10, and another significant number of cases you'll never exit. Venture capitalists want you out in 5 years. That means they hope you're out by 7, but they want you out in 5. And that's just because of the way that they rotate their funds. They try to bring in all the money and have everything called by 3. They try to have everything deployed by 5 at the latest, actually most of the time by 3, and they want out of everything in 5 to 7. So they're pushing you for 5 because they want out by 7.
I'll borrow that.
Sure. Are you going to bring it to your slide?
That way, because we have some people having a hard time hearing the questions.
So that's the difference depends on when you're raising money. Really early stage, 7 to 10 is okay. Venture capital stage, 5 to 7 is what they're looking for.
Gotcha. If I have 2 failed M&As that went through due diligence, do I mention this on the traction slide of the pitch deck? I am willing to explain the upside of the incomplete M&As and the higher value of our better position today. So does having 2 failed due diligence processes for an M&A aid or derail your pitch process?
It's a good question. I'm trying to think about it from a purchaser standpoint. Does it make me feel more comfortable that 2 deals have fallen through or less comfortable that 2 deals are falling through? I don't know. I think the net neutral is it doesn't make me feel one way or the other because there are lots of reasons that deals fall through. So I'm not even sure I would even mention it. I'm not sure it provides any value.
Okay. And then, let's see. The rest are just comments. So thanks for leaving. Keep going on.
Of course, and interrupt Logan anytime. All right. So let's talk about the other things that potentially investors are going to look at in terms of your due diligence, right? So they're going to look and make sure that you have realistic assumptions. Oftentimes you might provide assumptions, especially when you're diving into due diligence. They're going to be like, why did you say 5% growth or 10% growth or 20% growth per month? Where did that number come from? And they may want to know specifically how you arrived at those numbers. The other thing is this 1% market share. The only reason I put this on the slide is I see this all the time, and typically investors roll their eyes when they see this. If someone says the market is X big, and if I just get 1%, the business is this big. Because it's such a common statement, most investors kind of think it's a bit naive. And so they roll their eyes when they see that. What does the cash flow timing look like? So your cash flow statements, are your expenses reasonable? Are you paying yourself $300,000 as a founder? They're worried about those things. Do you have realistic revenue growth numbers? What do the margins look like in the business? Is this incredibly tight margin business or does it have lots of margins, especially in startups? If your margin is 10 or 15% as a startup, it's a disaster. I mean, you can never navigate all the execution risk associated with that and have low margins. So typically they want to see good margins. And then finally, cash management, obviously balance sheet. What do they look like? They're going to expect to see those things. Specifically around cash, I had a business partner one time and he took 3 companies public. And he used to always tell me 2 things. One is before you need to raise money 6 months before you need cash. Because if you wait less than that, then what's going to happen is you're going to be in a bind and you're going to take deals that you shouldn't take. And the next thing you also say is that there are only 3 things you have to worry about when you start a company. The first is how much cash you have. The second thing, can you see how much cash is in your bank account? And the third thing is always keep an eye on the cash, right? So his point is that is incredibly important. So make sure that you know how much cash you need and when you need it. All right. So what else are things that they look at? Sometimes they look at the general impression. So how do they feel about you guys that started the company? What's the culture of the organization? They might ask to talk to your employees. I've seen that happen on occasion as well. They might ask for references. Who are other people that you know in the network that they might know and they feel comfortable with you because by proxy, they feel comfortable with someone else who will vouch for you. They might ask to talk to customers. They might ask to talk to other investors. They might ask why early investors aren't participating in this round, and they may contact them directly to find out what's happening. The investor may say, look, I don't have any cash. I basically invested in some other deals. I don't have any dry powder. Or there may be, I don't think you can pull it off, right? So they might ask for those things as well. You have advisors, and who are they? Yep, sure.
I have a question about that.
Yeah. So the question from Chad was, if I've got investors that have invested in an earlier round, and I'm raising at the current round at a valuation that is at the cap, how do I explain to new investors that my old investors aren't wanting to participate in the current round? Now, there are lots of reasons they might not participate. One is, as I mentioned, they're just not actively investing in the moment. They may be distracted in being a month in Italy. Like, it could be a million reasons. So as long as there's valid reasons, then the new investors feel okay. Now, the reason sometimes they ask is oftentimes early investors will invest at least at the rate to maintain their current potential share, depending on what the dilution looks like in the new round. Right? So they may say, well, based on those numbers, I'm a 5% shareholder, and if you're going to raise additional money, I do face a little bit of dilution, but I might actually participate in order to keep my share at the same level. Sometimes they will, just to maintain that, right? Especially if they think the trajectory's still going, right? They're like, wow, this has been de-risked a lot since I got in early, and so I might participate again. Okay. But they will definitely ask if any of the previous investors are investing. So just have whatever the answer is, and you've only got 4, so you may have valid reasons why each of the 4 aren't. Right? Let's see. They may actually talk to competitors. They may push you back on valuation, which is obviously often the case. And then I'm going to go through a couple more things that I need to. Yeah. All right. So finally, if they've gone through all that due diligence, there's a yes or no point, right? So I should still invest or should I not still invest? And the reality is for investors is if they've gone through that due diligence process, every deal has problems. There are no deals that are perfect across the board. No deals, right? But the reality is if they've gone through the due diligence process, do they still believe that it's an opportunity or not? And then finally, do they feel like they can provide value? Oftentimes, investors will look at the deal and say, hey, I know something about your industry. I'm willing to invest, and I might actually be able to help you with my network improve the value of my investment. And then finally, there just needs to be some sort of process to decide. When I process, what I mean by that is, who votes? Do you decide individually, and make sure that you as a founder know what that process looks like? All right, so let's do this. We've only got a few minutes, so let me do this. Who has questions about due diligence? Yes, ma'am. The question is, what are some of the things that you should look for about whether or not you're comfortable or not taking money from a specific investor? Now, investing, especially early stage during the due diligence process, this is the dating phase. So usually when people are actually dating, they're on their best behavior. The marriage phase is after the deal is done. If it's rocky in the dating phase, you're like, man, this person is a little overwhelming. I don't really like their personality. They're a little too abrupt in the way that they deal with me. After the investment, it's worse. Right? So definitely watch that. The other things is you should talk to other people or other companies that they've invested in the past. And if those people are like, yeah, they're a pain in my ass, then that lets you know that, hey, this is probably not someone I want in my deal. Now, it's okay sometimes to have somebody that's a pain as long as they're providing considerable other value, right? So those are some of the things that you should look for. What other investors that they invested in, and how do they feel about them as an investor? And then also, what has the due diligence process been like? And if it's been incredibly demanding, which they should be forward, but if it's been incredibly demanding and uncomfortable, then it's going to be worse than that once they come in as an investor. All right? The other thing is that if investors are trying to grab as much of your company as possible, that's a major red flag. And the reason it's a major red flag is that if the founder gets disincentivized, meaning they're not interested anymore because their share is too small, and they walk, then they have nothing. And so sometimes investors can be too aggressive on pulling too much control of the company, and then they ultimately lose the incentive structure for the founder. So that's something to consider as well. All right. Any other questions? You got some online?
There is a question from online from Robert. The question is, how do you know if the due diligence process for an M&A is not them just learning about the company for free?
You don't. But if you know who the investor is, then you spend a ton of time talking to other investments in their portfolio to make sure that's the case. That's what I would do. Are they going to learn a lot about your business? Sure. I think it's always tricky, especially if the M&A potentially comes from a competitor. But I think M&As are definitely different than early stage investing for sure.
Gotcha. Any additional questions from online or in the room?
All right, so here's what I'm gonna do. I'm gonna take 2 minutes. I'm just gonna talk about deal room and then we'll turn it over to JD. Now, I'm gonna describe what a deal room is. A deal room is a repository that has all of the different documents that investors would be comfortable or investors would want to see. Those things would include your deck. They would also include key employee information, potentially contracts, potentially customer agreements in some cases. They might also include the safe or the convertible note that you're going to use to raise the round. It could also include things like your cap table. The thing is that you want to give people access to your deal room for a number of reasons. It speeds up the process oftentimes. It also can create a lot of credibility early if you've built a good deal room, but you don't want to give just anybody access to your deal room. If you're gonna really consider them as an investor, then more than likely you would have already given them your deck. You probably would have provided them some sort of pitch, and you would have had a meeting or so with them before you sent them access to your deal room. All right. Now, I'll send Logan or Audrey my deck on deal rooms. There are lots of reasons that you should have one, but there are also reasons that you should be protective of your deal room and not give it to just anyone, because it has a lot of information in there that, quite frankly, unless someone's genuinely interested in doing the deal, that you probably shouldn't give them access to. Sometimes, if there's a lot of really proprietary information in your deal room, you might create two. You might create one with some basic information and then a second level deal room that you give someone access to, potentially if they've signed an NDA, if you're going to provide them some pretty proprietary information.
All right. Excellent. Thanks so much, Leith. Really appreciate it.
Yeah, of course.
Everyone, thank you so much for joining us for this next session. JD is going to go over cap tables, which we probably don't have enough time in a half hour to really dive into the nuts and bolts of this, but JD is going to lead us through a session and answer some of the questions you might have. JD is an investor, entrepreneur, and an attorney. He's recently joined the Craig Macy to create Macy Peters Law, a boutique firm servicing startups in Nevada, Texas, California, and Washington. JD graduated from Vanderbilt and earned his JD from University of Texas Austin. And he's been working quite a bit with a number of our startups within our ecosystem. And very excited to have him. JD, thank you for joining us. I'm going to kick it over to you now.
All right, fantastic. Well, thanks for the intro, Logan. I appreciate it. As you mentioned, my name's JD. I have a partner, Craig Macy, who's mostly focuses on intellectual property. I focus mostly on corporate and commercial transactions for our clients. We're up in Reno, and just happy to be here today. Honestly, I appreciate everyone's time. So the first slide is, of course, a boring slide that says none of this is legal advice. Every situation is different, and this is just general educational advice, nor does this presentation create any sort of attorney-client relationship. I'm here today to talk about cap table cleanup. And it's funny because founders, as you know, have a lot of things to worry about, not to mention product market fit and things of that nature. But one thing that can be a little confusing to folks when they start out, if they're unfamiliar with it, or even as they get more experienced, is just the kind of the concept of a cap table, right? Like, what is a cap table? How does a cap table develop over time? What are issues that can arise? And so today what we're going to talk about is some of those issues that can arise, how to fix them, how to avoid them in the first place. And so typically the starting point for any kind of high growth venture, most of them are C Corps, either Delaware or with this group, Nevada. And the reason for that are varied, but mostly have to do with qualified small business stock, which is a little beyond the scope of this presentation. But the important thing to note is when you initially start the company, it's really important to issue your founder shares right away. And so kind of the life cycle of the cap table is first the founders get their shares. And if there's more than one founder, it's very common to subject those shares to vesting, typically through a restricted stock purchase agreement where you get the shares, but they're subject to repurchase if you or your co-founder leave the company before a specified period of time. Typically 4 years is kind of the market for initial vesting. And while we're going to talk about cap table cleanup today, one thing that's really important, and if you don't take anything else away from this presentation, I would suggest you take this away. When you issue founder shares that are subject to repurchase or subject to vesting, you need to file what's called an 83B election within 30 days of that issuance. And if you don't, there can be pretty severe tax consequences down the road that you may not even realize are occurring until you get to a financing or an exit and investors or acquirers are asking about your 83B election. And then they bring up all the horrible things that are happening now that you didn't file it. And the reason I bring this up first is because this is one of those things that you can't really clean up. You can't really fix it. And so there's no exceptions to the deadline. There's really no way to fix it. So you got to file your 83Bs. So that's the first thing. And then, kind of the development of a cap table tends to move from there to issuing things like safes, convertible notes. Maybe you do your first priced round as a Series Seed, Series A, maybe even make it to Series B, and then you do an exit or something like that, right? And so as you go along, what the company is doing is issuing more and more shares. It's issuing shares to service providers, to employees, to investors. And so it's really important to keep all this documented, to keep all this organized. And here's a few of the reasons why. One is that it's simple and easy for investors and acquirers to understand, to review, and to confirm. So I know Leith was just talking about kind of raising money and that process. One of the things that you're going to have in your data room is all of your stock transaction documents. And so this is going to document the issuance to the founders, like I just mentioned, all the rest of them. And if you're missing some of those, people are going to ask about it, especially as you move along and the company grows and you're looking for higher valuations and more investment dollars. If you don't have that proper documentation, it's going to create real issues for you. And again, we'll talk about how to kind of clean those up, but the best thing to do is just get it right the first time. Another real important reason for a clean cap table is it helps you manage your internal stakeholders. If people don't know how much equity they own, if employees were promised options but they were never granted, that can create friction. There's all these kind of annoying situations, difficult situations that can arise if people don't have clarity with respect to your cap table. And then, maybe the most important reason to have a clean cap table is to avoid adverse tax consequences. So I mentioned earlier, it's really important for founders when they start a company, go ahead and get those initial founder shares issued as soon as possible. Because what can happen if you don't is you get down the road a little while, you've created a product, maybe you've even got some revenue and your company's moving along. It's clearly increased in value since when you started it. And if you go to issue your shares then, the IRS is going to look and say, well, hey, you're getting stock, not in a company that you started yesterday that's worth basically nothing, but in a company that's got revenue, in a company that's got employees, whatever it is. And they're going to say, well, really what you're getting is much more valuable stock. And so you either need to pay a higher price for that, or you need to basically, it's basically income, and so then you are taxed on that as if it was ordinary income. And so taxes are another reason why having a clean cap table is really important. Same goes for option grants. There can be pretty gnarly consequences for not understanding the mechanics and the specifics with respect to granting options that can lead to pretty bad tax penalties of 20% or more. So what are ways to mess up a cap table? Well, they're basically infinite, but the most common ones I see are, like I just mentioned, not issuing the founder equity at formation. Another one that I see that's kind of related is founders sometimes will have really complex or convoluted ideas with respect to how they want to create their initial cap table. there was a time where things like super voting shares were pretty prominent. You may be familiar with, like, Mark Zuckerberg has these super voting shares where he's just been able to maintain complete control over the course of the development of Facebook. And so, those are nice. They're great for founders, but they can really turn off investors, not just from a rights perspective, but also kind of from just a complication. What I tell people is, when it comes to your initial structuring, what you want is a structure where you can just give someone access to your documents. It takes them 20 minutes to look over them. They check off all the check marks on their checklist, and they move forward. What you don't want is to have a bunch of conversations and a bunch of confusion around that initial cap table. Number two, failing to have the board approve equity grants. Every equity grant needs to be approved by the board. And where you see this go wrong most frequently is with respect to employees and granting options. Often you'll see, hey, here's an offer letter that has an agreement that we're going to grant you an option. Now, one thing to keep in mind is that agreement should always say that the option grant is subject to board approval. But then it's critical that the board actually grant that option, because that agreement itself is not actually mechanically enough to grant that equity. And so by failing to do so, you can run into a few problems. One, maybe the employee didn't actually ever get the equity, and that upsets them, and they're wondering what's going on, and kind of wondering what's going on with the company in terms of organization, things like that. Maybe the bigger issue is options need to be granted at the fair market value on the date of grant. And so to the extent that you grant options later on in a company's life cycle, very likely the exercise price is going to be higher, which means for the employee, they're receiving less benefit because they need to either come out of pocket, or often it's just kind of a net exercise concept. But basically, if instead of granting someone an option at a penny a share, you're doing it at $1 a share, that employee is losing out on 99 cents per share worth of value. And so granting options shortly after they're promised is important. Not documenting equity issuances properly is probably the most common issue. Not having proper board approval, not having a stock purchase agreement. Those are the things that every sophisticated investor that brings in a law firm to look at your documents is going to want to see a board approval and a stock purchase agreement or an option agreement for every single grant on your cap table. A big no-no is issuing more shares than are authorized. Now, this can create real problems from a corporate governance standpoint and from a relationship with the state and that sort of thing. But basically, certificates of incorporation, articles of incorporation, what they have is they have a set number of shares that the company can authorize. And so say that's 10 million. Well, if you grant 10 million and 1 shares, that 1 share, that last share, is actually completely void. That's a completely void action by the company. They're unable to grant that. And so even if you think that you've granted someone equity, you have not. And so that can create a bunch of different issues. And the last one on the list here is accepting bad terms in a capital raise. And this doesn't necessarily go to, hey, your cap table is a mess and deficient, but what it can do is it can lead to future investors saying, well, this is just a cap table that I can't be a part of. The rights of the previous investor are too strong. They have too many blocking rights. The founder doesn't have enough equity. He's not properly incentivized, or something like that. So that's another way. How to clean up a cap table. I've been describing it a little bit. Do it correctly initially. Issue promised but ungranted options as soon as possible. This is one that I see all the time. People enter into employment agreements or independent contractor agreements that contemplate some equity grants, and they just never get around to actually doing the board approval to do the grant. And like I said, that can lead to a bunch of issues. So that's a key thing in terms of managing your cap table. If for some reason you created an initial cap table that isn't really what people expect in kind of the high growth area, most of the time people expect an initial cap table in the range of like 5 to 10 shares issued initially to the founding team. Maybe a portion of that is set aside for the option pool. Well, maybe you did it on LegalZoom or something and you got 1,000 initial shares. Well, one way to kind of help clean that up is through stock splits, reverse stock splits. You can do these various things that need board and stockholder approval and need filings with the applicable state to allow you to basically right size your cap table for what people are expecting. And it's interesting because in terms of the actual number of shares, the absolute number of shares, it doesn't matter really at all. It's all completely arbitrary and it's all relative to what other people have, right? So if you have 1 share out of 100 shares, you have 1% of the company. Well, it's the same thing. If you have 1% of 10 million shares, you just have a whole lot more shares, but you don't have actually more ownership in the company. But nonetheless, there's kind of customary cap tables that people expect to see. And again, having one of those just allows you to breeze through the cap table diligence portion of a diligence process, basically. Let's see. And then there's if you really screw stuff up, if you issue more shares than are authorized, if you thought you had issued shares previously that you hadn't, there's procedures under both Nevada and Delaware law that can allow you to ratify these invalid corporate acts. So in Delaware, it's section 204, and it's basically a self-help statute that allows you to ratify corporate acts. And what it says is that no defective corporate act or putative stock issuance shall be void or voidable solely as a result of a failure of authorization if ratified pursuant to section 204. And what 204 basically allows you to do is to say, hey, we meant to grant this stock to this person. We've been acting as though we granted this stock this whole time. But we never documented the board minutes, or we never actually held a board meeting to do so. Same thing with options, all this kind of stuff. And so what you're able to do through a relatively formal process is have the board go back and say, look, this is what we meant to do, basically. If stockholder approval would have been required at the time of the issuance, stockholder approval is required again at the time of the ratification. And so you're allowed to basically clean stuff up. And before, I believe this came into effect in 2014, before that, there was really no way to do it. And so you could just be totally stuck if you didn't issue shares properly or had other invalid corporate acts. And in this case, it basically allows you to do it. What's nice about this, it allows you to do it on your own. There's another provision which is not used very often, but you can actually petition the Delaware court to validate certain acts for you. That's really beyond the scope of this and not something that frankly I've ever done, but it's available for acts that require that. In Nevada, there's a very similar statute, 780296 for corporations, and it basically establishes, it's interesting because it establishes non-exclusive procedures or ways to ratify or validate corporate acts that are not taken in compliance with Nevada law. And so what you do there is basically the same thing as Delaware. You have the board say, hey, this is what we meant to do. If the stockholders are required to approve it, the stockholders need to approve it then. And it just allows you kind of a way to clean things up if you screwed them up. And what I would suggest when it comes to these things, a lot of times these issues come up within the context of a capital raise or an acquisition. And I think one thing that's important is as you go along, if you feel like, hey, there's issues with my cap table, right? I don't really understand what I'm doing, or, it just seems like maybe I'm missing something, or I don't have proper documentation. What I would suggest is getting help with those basically sooner rather than later. And the reason for that is because your level of credibility is much stronger and higher if you can go to a potential investor and say, hey, here's our cap table, we're comfortable with it. to the extent you need to explain the ratification documents and that process, I think at least it shows that you were proactive about fixing it. And not just proactive about fixing it from hey, we're doing the right things, but also just from a corporate governance, from a taxes, and all those various perspectives that I talked about at the beginning. Having that really ups your credibility with investors in terms of, hey, this cap table looks good. We're ready to move forward. We're comfortable with what we own. Because the last thing investors want is to not understand what it is that they're buying. And so if an investor's coming in and they say, we're expecting to own 20% of the company, and we'll invest $1 million, right? What they don't want is, what they do, basically, the way this process works is there's an Excel spreadsheet that says, here's all the outstanding shares. Here's the option pool. If there's convertible securities like safes or convertible notes, here's how much we have outstanding. Here's the valuation cap. Here's basically the math on what this will all convert into. And the investor takes this and they, do the analysis and make sure the math all looks good. And they say, great, all right, well, we're getting X amount of shares. And what's a big problem is if someone comes later and says, well, hey, I was owed a bunch of shares too. And then the investor all of a sudden, instead of owning the 20% they expected, owns 18% or whatever it is. That creates a lot of friction in terms of investor relations. You'll almost certainly have to top them up with additional shares, which can be, not a big deal, but it can be just kind of a messy process in terms of just maintaining that level of credibility. And to me, having a clean cap table is a great way to kind of show like, hey, I may be a startup founder. This may be my first venture into this world, but here's my clean cap table, and you can feel comfortable that this is good to go, and you can go from there. On the acquirer side, whenever you do an M&A deal, you make a ton of representations about your company. And one of the most important representations is about the cap table. And what it says is, here's how many shares are outstanding, and here's how many shares are available in the option pool or whatever. Here's how many options are outstanding. The last thing a buyer wants, and the sellers will be on the hook for any inaccuracy, is for someone to come in later and say, oh, hey, I was owed shares, right? I was owed 1 million shares of this company that was never issued. Maybe they have an agreement that says that, whatever it is. And all of a sudden, everyone that was supposed to get a certain amount of money gets less money because of this issue. And so having a clean cap table is really critical from an initial perspective with respect to taxes as you go forward with respect to investors. And it's probably most critical at exit, because buyers are just not going to take any risk that what you're telling them about your cap table is inaccurate. And so any issues that come up, one, may just tank a deal, frankly. I mean, investors are not interested in cap table risk. Purchasers are not interested in cap table risk. And so it may just tank a deal. It may lead to you having to do some of these corporate cleanup matters kind of in the 11th hour, which can be stressful on top of everything else that goes along with an M&A deal. And it's just really something you want to avoid. So, to back up, clean cap table is really important. The best thing to do is to do it right the first time. There's ways to clean it up. Most of them are not that complicated. Doing it sooner rather than later is better in terms of credibility and in terms of everyone just being able to understand the cap table and what's going on. And then if you really screw stuff up, there's almost always a way to fix it. So, I don't want to scare anyone here into thinking, hey, oh my God, my cap table's so screwed up. I'm in a really bad place. Like, there's ways to fix it almost all the time. Not 83Bs, file your 83Bs. But basically everything else can be fixed. So that's really it. I mean, I know cap table cleanup maybe is not the most exciting topic in the whole world, but it's important. And really what's most important is just having that clean cap table one way or another.
Absolutely. JD, really appreciate it. Thank you so much. We definitely have a couple of questions on this. So for our first question, from in the room. This founder actually incorporated their original business over 8 years ago as a Nevada S Corp. Now the question is like, should they reincorporate to a Delaware C Corp? And they haven't issued equity. Didn't have any investors. It's just solely them. Should they reincorporate as a C Corp and what would that process look like?
Yeah, so again, not getting too into specific examples, but generally speaking, S corps are great if you don't want to take investment. The problem with S corps is they have what I would describe as arbitrary rules with respect to who can own them. For example, it needs to be only individuals, which basically eliminates the entire venture capital world immediately. You can't have any foreign investors. And so if you're thinking about, taking it and reincorporating as a Delaware Corp, I think you need to kind of understand why, right? Are you looking to take in investment, for example? I mean, that would be kind of the main reason to do it, in my opinion. If not, S corps are great for certain businesses. S corps don't have 2 layers of taxation. So unlike C corps, the big difference between C corps and S corps is that S corps are flow-through entities like a partnership or an LLC, whereas C corps have entity-level taxation. And so if you're an S corp and you're just thinking, oh my gosh, everyone's a C corp, I should become a C corp, that's not a compelling reason. What could be a compelling reason is, I want to go out and I want to raise money. That can be a compelling reason. Honestly, the most compelling reason for C corps, generally speaking, is something called qualified small business stock. And the reason that you always hear like, oh, VCs want to invest in C corps, one, they're more scalable from kind of a employee equity, and that second layer of taxation, that corporate level of taxation, actually can come to your benefit if you're losing money all the time because you get a bunch of NOLs that have value. But qualified small business stock allows you to totally exclude from taxes the greater of 10 million or 10 times your basis if you hit the various requirements, one of which is you have to be a C corp. And so, a lot of startups, high growth startups, fit kind of what you need to be in terms of to qualify. And so they want to be a C corp because that potential tax break is just enormous.
Excellent. Thanks, JD. Another question. This founder has actually raised a little over 800K from 4 investors on a safe note. Now, when they convert, is it okay for those 4 individuals to have their own line items on the cap table, or should they roll them up into an SPV or an LLC when they do the conversion, or some other route? What's the answer? What would you recommend?
So I don't have a problem with it. I mean, sometimes people like to use SPVs to basically round up a bunch of smaller checks, right? What you don't typically want is a cap table that's got, 30 of your friends on it that all invested $1,000, right? That's not a good situation, because there's various times when, ignoring kind of everything else about it, there's various times where you'll need stockholder approval. And so if you're able to say, hey, there's this SPV that invested 30, there's one person that manages it, all I have to do is go to them to get the approval from them, that's really helpful. The other thing is, if you have a very early stage company and you've got 50 people on your cap table, that's going to look odd to investors. They're going to want to understand what's going on. But if you just have like 4 people that have invested and they've invested significant amounts, I don't have a problem with them being on the cap table individually at all.
Excellent. Thank you, JD. That did answer the founder's question. From Dan online, regarding founder motivations and initial founder shares, is the process of reverting founder shares back to common pool arduous?
So I'm not totally sure I understand. If what you're saying is, let me just describe how I typically set up a pool. So like what I like to do is 10 million authorized shares. I like to do an initial structure of 10 million because I think it makes the math a little easier. And so what typically happens is, say there's one founder and they want to set aside 20% because they need a technical co-founder that they want to give 10% to or whatever, and then the rest is available for everyone else. What I do is I say, okay, the founder gets 8 million shares and then there's 2 million shares set aside. If what you're asking is how to increase that pool, you don't actually need to revert any founder shares. You can actually just increase the size of that pool. Now you'll have to make sure that it works with respect to your governing documents in terms of how many authorized shares do you have, but you can take that pool from 2 million to 3 million or 4 million. And by doing so, you dilute the founder, assuming you issue all those shares. But there's no actual requirement that the founder contribute back their stock to the pool. Did that answer the question?
We will feel free to put some more in here if that didn't, and I'll try to address those. From Ben, Ben has two quick questions. Why would a startup have a multiple classes of stock, especially in a pre-seed seed stage? What do investors think of this? And then from that, and then later and then he's got one more question after that actually. So we'll go ahead and start with that one.
So the reason, first of all, I don't suggest it. I suggest keeping it clean. I think common shares to the founders is what is expected in kind of the global capital markets situation that we're in, especially with VCs and angel investing. Things like ultra special voting, ultra control specific shares to founders are very much disfavored. The original reason for those kind of dual classes was to allow founders to maintain control pretty much no matter how much equity they sold. Think Facebook, for example.
Gotcha. All right. And then a quick question: why do venture capitalists frown upon investing in LLCs? And you kind of touched base on it when you talked about the difference between C Corp and S Corp, but if you can lend your 2 cents there as well.
Yeah, sure. So the main reason, I'll call it the tail that wags the dog, is qualified small business stock. There's just such an opportunity if what you're doing qualifies for this exclusion, and frankly, most like software startup companies qualify. It's negatively defined in terms of what doesn't qualify. So there's some line items in terms of what doesn't qualify, but most kind of high growth startup companies qualify. And it just provides this opportunity to get literally tax-free returns up to 10 times your basis. So if an investor comes in and invests $1 million, there is a cap at 50 million, but they're able to get basically 10 times their basis, which is $1 million, tax-free. And like I said, there is a cap at 50 million. So they're able, regardless of what their returns are, they're able to take that first 50 million in return completely tax-free, federal income tax-free. So it's a windfall that the only analogy I can make to it is if you sell your primary residence, there's certain exclusions. If you're a single person and you sell your primary residence, I think it's like $250,000, you can get no tax at all. It's basically exactly like that, but much higher in magnitude and for a totally different type of investment.
Yeah, excellent. And then our last question, and sorry, folks, you definitely can reach out to us with any follow-up questions, and we'll forward those to JD or our staff. What are the disadvantages or advantages between, what are the differences between a Delaware and a Nevada C Corp? I think this is an appropriate last question of this session.
Yeah, so there's a few differences. Some are more interesting than others. I'll say the thing about Delaware C Corps is that it's just become the norm, right? And so people expect it. And because of that, to the extent you have something different, you have to explain why. Now, I think Nevada as a place to incorporate is gaining a lot of momentum. Maybe you all saw that Twitter recently, or X, whatever it's called, recently reincorporated as a Nevada Corp. I think that's going to have, that's the kind of thing when I'm talking to people, you want to be Delaware, you want to be Nevada. Saying something like that really gives Nevada credibility in terms of a place to incorporate. Yeah. So that's kind of the top level, right? Like, why do people do this? Well, because everyone does. And that may not be that interesting, but that doesn't mean it's not that important. What's more interesting from a legal perspective is Nevada corporations. The structure of the Nevada corporation law is actually far more protective of officers and directors than is Delaware law. Delaware law is more protective, basically, and allows more opportunity for stockholders to bring claims, fiduciary duty breaches, basically, against directors and officers. In Nevada, the standard is basically fraud. So in terms of protecting yourself from a personal perspective, starting a Nevada corporation is a great way to go, because unless you're just out there committing fraud, you're gonna be protected in basically every single case. So that, I'm sure that's why Elon did it, frankly, is because of that. And that's kind of interesting. And then the other reason, if you're in Nevada, you get two sets of fees. So if you file if you create a Delaware corporation, you have to pay all your fees to Delaware, but then you also have to pay fees in whatever state you're doing business in. And so that can just be, one, annoying. It can get a little expensive as you go. It's more paperwork, it's more complication. So to the extent you want to avoid that as you're starting out, you can do that. And if you get an investor that says, hey, I need you to be Delaware, you can always convert at that time from a Nevada corp to a Delaware corp.
Gotcha. Excellent. Thanks so much, JD. Everyone, that concludes this session, and that also concludes the capital raising boot camp of the Founder University series. After this, we're going to take a break, and we will resume on September 14th with company culture. Also, this session will be made available, and the slides by Sunday, and they will also be made available on the Founder University online portal. So those of you that registered for Founder University, you have access to an online portal with all this content and additional free resources. So please take a look at that, and we're excited to bring that to bear for all the founders. JD, Leith, thank you so much. Really appreciate your time today, and we will see you all on the 14th.